Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. In today's episode, we'll take a closer look at the Medicaid spend down, what it means for your assets and eligibility, what you can do to prepare and protect your financial future, and the do's and don'ts of lending to friends and family. And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm joined by Cole Bruner and Kaylee Berenson of Buska Retirement Solutions and Buska Wealth Management. In this segment, we're breaking down a topic that's critical for anyone planning for long-term care, the Medicaid spend down, and what it means for your assets and eligibility. Thanks for joining us today.
Of course.
What exactly is Medicaid spend down and what is that process?
Well, Medicaid spend down is going to be a process that allows individuals who exceed the income limits or the asset limits set by Medicaid to still be eligible and still qualify for those benefits. So it allows them to spend down that excess income or those assets on qualified expenses. So the process would be, contacting your local aging or disability resource center, and then you can apply online or via telephone. You can also fill out a paper copy if you'd like to. But if you exceed those income limits, then you're going to ask them for that spend down option and see if it pertains to you. And if you can use that, then you can use it on qualified expenses like doctor visits, hospital bills, or prescription medications to become eligible for those benefits.
Yeah. So how does that spend down then affect that eligibility?
Well, I think in terms of spend down, I mean, you have Medicaid sets limitations on how much you can have in assets overall in order to qualify for Medicaid benefits.
And just to be clear,
Yeah.
Medicare, Medicaid.
Two different things.
Two different things.
Yeah, so Medicare is essentially what almost every American becomes eligible for at age 65
Sure,
for their health
for-
insurance.
yeah.
Exactly, yep. Medicaid is going to be more for people that are considered financially needy in terms of the limitations, because the limitations are pretty low in terms of how much you can have in assets to qualify. Yep. It's most applicable to a lot of clients in retirement for long-term care concerns, right. Nursing home stays, things along those lines, because that's most often when Medicaid spend down is going to come into play the most significantly, because of course Medicare doesn't necessarily cover long-term stays in nursing homes.
Now, you guys have a way more technical definition than I'm going to have here, but the way I understand it, and so before I ask this next question, is the government's happy to, Medicaid, help you pay for retirement health care situations should you not have the money to do it.
Right.
But you need to not have the money to do it first.
Correct.
So the Medicaid spend then is higher from the government towards your retirement if you qualify. Mm-hmm. Are there, that's one of the fears for people is you hear the average nursing home cost is $8,000 a month or whatever the crazy number is, and that it's going to take all my assets, not leave anything behind, take my house, you hear all these things.
Yep.
Are there legal strategies to employ that spend down to get under that threshold?
There are a few strategies that people can take advantage of. So first, I would say strategic gifting. So right now, the federal gift tax rule is you can gift up to $19,000 per individual per year. So some people will take advantage of that and kind of do like a staggered gifting approach. If you can plan far enough in advance, because there is the 5-year look back that Medicaid will look to see if you've gifted any assets in that time period, which could make you ineligible for those benefits.
Yeah.
Yeah, and another strategy would be an irrevocable trust or a Medicaid asset protection trust. So you can set that up with a local attorney and establish that trust, but that does also have the 5-year look back. So you want to be aware of that, and it is irrevocable, so you can't really change it, and you kind of give up control of those assets. But it is, a viable option for people that are looking to protect their assets from, nursing homes. And then lastly, I would say Medicaid compliant annuities. So those are going to be immediate annuities, and it's, you take a lump sum of money, you fund that annuity, and then you start getting an income stream. Right. That income stream is going to be based off of the average life expectancy of the person collecting those payments, whether it's the applicant or the non-spouse applicant. So it is a good option for married couples to take advantage of that, but it is also irrevocable, so you can't cancel it, change it,
Right.
cash it in. So just be aware that it is also permanent, but it does avoid that 5-year look back.
Saying if it's not your money, then it's not your money.
Right, exactly.
Lots
So
of
there's
restrictions.
lots of rules, but
Yes.
they're pretty clear cut and
Yeah,
and you
I
can
mean,
almost understand where they come from.
Yeah,
I'll pay
and-
for you, but you pay for you first.
Right.
Right.
Yes.
Yep.
Yep. And you know, we've spent lots of time reading the Medicaid eligibility handbook. And
Don't threaten me with a good time.
Exactly. it's very dry reading material. But I mean, even in our own life personally, I mean, with our grandparent, one of our grandparents that had. Dementia, you know, we had to look into all of these things to figure out what's possible, because in the event that she needed to go to a nursing home, we were concerned obviously with, you know, the spend down process and what
Right.
that looked like and what's considered a divestment versus what's not considered a divestment,
Yeah.
and what's going to trigger the 5-year penalty period and what wouldn't trigger it. So it definitely is a very, very, a very restrictive type of regulation, but if you understand how it works, you could potentially use it to your advantage.
And I won't make you guys get into it now, but I know some of the bigger fear is a married couple living in a house. One goes to the nursing home because I can't physically care for them.
Right.
Do I lose the house at that point? Or now I'm alone, I can't physically take care of the property. I go to the nursing home, do I then lose the house? And that's a big concern. That house has been in the family for decades, whatever. But
Yeah.
if you have any questions on that, make sure you give them a call. It's a process.
Yeah.
Why is it important to think about Medicaid spend downs early in the long-term care planning process?
Well, I think because of the fact that there is that 5-year penalty period, that 5-year look back essentially. So if you get to the point in life where you're now dealing with maybe ailing health and this is becoming a concern and nursing care might look like it's on the horizon, you might not have enough time to put these plans in place. So thinking about this well in advance, way before you would potentially think you would need those types of services, it's just going to give you more time. And also, in the event that the state changes some of those look back provisions, I mean, because that could change in the future potentially, you want to be prepared in the event that they don't grandfather that in or anything along those lines, because if the 5-year goes to 10 years for whatever reason in the future, now that means you have to have even more time to let that kind of season in your plan before it's really going to give you the full benefit. So I think doing so earlier rather than later is way more valuable.
Understood.
Yeah.
And that's the 5-year look back then. Is that basically the way of saying you couldn't have planned for this 5 years ago, so you did it. You did it for the right reasons versus I did it yesterday. Can I have some Medicaid, please? Kind of
Exactly.
the idea behind that?
Right.
Very good. All right. Let's come back for more on this here.
Yeah.
After a short break, we'll look at how thoughtful planning may reduce the financial impact of a spend down and how families can protect what they've worked so hard to build.
And now back to our weekly question and answer segment.
Welcome back to our conversation about the Medicaid spend downs and how they tie into long-term care planning. Before the break, Cole and Kaylee helped explain the basics of how spend downs work and why they matter. Now let's explore what you can do to prepare and protect your financial future. Thanks for joining us again.
Yeah, of course.
What type of assets can be counted or countable in Medicaid spend down, and what are the exemptions?
Yeah, absolutely. So when it comes to countable assets, those are going to be things that are easily converted to cash. So bank accounts, your checking, savings, money market, CDs, your stocks, bonds, other investments that you might hold, and then life insurance with cash value, and then real estate that's not your primary residence. So those would be countable assets. So Medicaid would have you, spend those down before you would be eligible for benefits.
Yep.
When it comes to non-countable or exempt assets, those would be things like your personal belongings or your household items, like your furniture or your appliances, if you have a vehicle or a burial space, and then also your primary residence usually is not countable as long as you or your spouse are residing in that house, or you have an intent to return back to the home. So I know you mentioned that before, but they're not going to kick you out of your home if you or your spouse live there or intend to go back to the home. But after you pass or your spouse passes, that's when Medicaid will have their estate recovery program. So the house wouldn't be exempt from that. So you just want to make sure that you have all of your ducks in a row, and you protect those assets. And even after you're gone, your loved ones can inherit that house, and Medicaid can't come after it then.
Yeah, and that's where some of that irrevocable trust could potentially come into play and benefit. If the trust owns the home, then it helps to provide a further exemption on that asset.
And let's dig into that one a little bit. How can early, you hear trusts?
Yeah.
Think estate planning. Some people think, well, I don't have an estate. I'm not the Rockefellers over
Right,
here.
right.
But how can early estate planning and trusts help get ahead of that or prevent that?
Well, I think it kind of goes back to what we were talking about in the last segment, where the more advanced, or the more in advance you do this type of planning, the more prepared you're going to be for what may come in the future, because you have no idea what the future looks like. I mean, you could have an accident and be incapacitated all of a sudden, and you need nursing home care at 65 years old. I mean, nobody knows what the future holds for them, right? And so doing this type of planning earlier rather than later can really benefit you, especially in terms of the asset protection planning, with these irrevocable trust and Medicaid-friendly trusts and those types of things. Those are going to be things that you're going to want to really dig into to figure out, one, does it make sense for my situation? And two, if so, when should I incorporate that? And of course, that's where you'd work with a local estate planning attorney that specializes in that area, because of course you want to deal with somebody that really is an expert on that estate preservation or asset protection component of estate planning. And so working with them, understanding the rules and the regulations and the laws, and then getting from their perspective and their legal expertise, when should I complete these documents?
That's an interesting, you assume an attorney can handle all legal matters.
Yeah.
And they can, but
of course.
This is obviously a specialty. Divorce is a specialty, and
this is a very sophisticated
right.
style of planning.
Yeah.
Absolutely.
Are there key timing considerations when trying to plan for Medicaid eligibility? Is it age specific, anything like that?
I'd say there's not a whole lot of key timing considerations, honestly, besides that 5-year look back. Being aware of that, they're going to be checking to make sure in the last 5 years from the date of your application, have you gifted any money or have you sold anything under fair market value? Right. So then, you could be ineligible for the benefits. So they have that look back period, which could lead to a penalty period, resulting in ineligibility for a certain period of time.
Yeah.
And so it's going to be a calculation based on how much was funded in that look back period versus how much your care costs. So if you gifted $100,000 in the last 5 years and your care costs $10,000 a month, well then there's 10 months of ineligibility for coverage.
Yep. Got it. Exactly.
Yep. And then also just being aware of that federal tax rule of that $19,000. It's not exempt, so you cannot gift that. And then still think, well, it's within the limits, I can do that. You can't do that.
It's still going to be considered a divestment. And,
Right.
if you're dealing with that type of thing, that divestment section of the Medicaid eligibility handbook is really enlightening. I mean, it at least helps you to understand what the government is going to look at in terms of what you would be potentially doing with your financial accounts or real estate or anything like that, and what's going to be considered allowable and what would be a situation that would cause a penalty.
Right.
How can working with you guys, I mean, you mentioned a Medicaid planning attorney, but how can working with a financial services professional help somebody create that strategy? It almost seems like there's a rules part, protection part, and then you've got to figure out the money part. How do you guys help quarterback that for people?
Well, I think making sure that they have estate planning documents in place, making sure that they understand that these types of estate planning structures work, and
Do you find a lot of people with estate planning documents, or what?
Not a ton, to be honest with you. I would say, based on just averages, I would say it's probably about 50-50, maybe a little less of people that come in with absolutely no documents whatsoever, not even a will or power of attorney or anything along those lines. And so, certainly we can assist him in completing the more basic estate planning documents, will, powers of attorney, a revocable trust. Those we can do through our partnership in-house, but we also then would refer them out locally to an attorney if they're looking for that more sophisticated style of planning, like asset protection, irrevocable trusts, those types of things, because that's where you really want to work with somebody that's going to understand what you're trying to accomplish and draft a document specific to your needs. So I would say we can help to enlighten them on the things that they potentially would want to look into. Certainly we can't provide advice in terms of law and legal planning, but we can provide a little bit of guidance and at least help them understand the things that we have experienced from an advisory standpoint.
Right.
And help point them in the right direction of where they could go to get some of those answers.
And then if you have attorneys you refer to that you can then work with and help.
Of course.
Help me figure out what they said and
absolutely.
You said.
And retitling of accounts and changing beneficiaries and all of those different things that go with creating that type of an estate planning document. That is all stuff that we can assist with and maybe help offset some of that cost from the attorney's standpoint, because we can handle some of the heavy lifting on making those changes, so that way the attorney isn't billing an hourly rate for changing your beneficiary on your investment accounts or changing the ownership of an investment account or something like that.
Right, and I know for a lot of people they're afraid of the nursing home costs.
Of course.
And you say some people say, well, I'm never going to go to the nursing home, but if you live by yourself, chances are there's no option. You can't take care of your grass and house and whatnot. Are you finding a lot more people are concerned about this long-term care? The baby boomer generation's not 60 anymore.
Right.
Right.
Absolutely. They're getting older, and certainly I would say as people experience that in their own personal lives, that awareness ticks up and that concern ticks up. And I would say the vast majority of clients that we work with don't have protection in place for long-term care needs, whether that be in-home health care, assisted living, nursing homes, whatever their level of care would potentially be in the future. We find so many people that are not addressing that potential concern within their plan. And so at the very least, looking at what's available, long-term care insurance, life insurance with long-term care benefits, all of these different things, asset-based long-term care solutions, long-term care annuities. I mean, there's all sorts of stuff that you can look at now. That's not just the old-fashioned long-term care insurance that everybody has heard, oh, it's so expensive.
Use it or lose it.
Right, exactly. And that's all true. I mean, and those policies still exist, but at the end of the day, there are alternatives. And so as we've exposed some of these clients to these alternatives, we've had a lot of people that are like, hey, this is great. I really want to get involved and get some sort of protection in place for my personal situation.
Good. Well, thank you, guys. I know this is a topic that's becoming more, I don't want to say popular, more prevalent for sure.
Right.
So if you've had that experience in a loved one and you think to yourself you should do something about it, you should. If you haven't had that experience, you should definitely do something about it. So visit their website, call in here, set up an appointment just to talk about it.
Yeah.
Thank you guys for joining us today.
Of course.
Thank you.
We'll be right back with more Financially Speaking.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Sue Buska from Buska Retirement Solutions, and joining me is Ryan Connor. Now today, Ryan and I are going to talk about loans, when to give them, when to refuse them, and which lenders to avoid.
That's right. Investopedia's article titled Do's and Don'ts of Lending to Friends and Family has some useful tips for navigating tricky issues that come up when someone you know wants to borrow money from you.
Did you ever see the episode of Everybody Loves Raymond in which Robert tries to go to Las Vegas with money that he borrowed from Raymond?
No, I didn't. What ended up happening?
Well, Robert and Ray had a huge fight.
Do you think the advice from Investopedia's article could have helped them?
Well, let's find out.
So first off, the article points out what we already know from that Everybody Loves Raymond episode. Loans between friends and family can be fraught with peril.
Well, it goes on to say that if you take a loan from friends or family, or if you give one, treat it like an actual loan.
So if you lend me $20, I should pay it back with interest?
Well, absolutely. That sounds good to me.
All right, so let's talk about when it might make sense to take a loan from friends and family. The article points out that 20% of adults in the US get support from friends and family, and 1/3 of adults provide support.
So loans between loved ones are fairly common.
And that seems to be the case. However, not all of the financial support we're talking about in that article comes in the form of loans.
So what about if someone doesn't qualify for a bank loan?
Yeah, so if your friend or family member can't qualify for a bank or other loan and you want to help them out, it might make sense to loan them the money.
Now, a younger relative who wants to start a business but doesn't have enough credit history to qualify for a bank loan could benefit from a loan from friends or family.
Right.
Well, what if someone needs money quickly? Like, let's say their windshield is cracked and their car isn't street legal until they get it fixed, and they need a car to get to work.
So that would be a good time to give someone a loan rather than make them wait to go through more official channels, which can be slower.
Right. And what about co-signing loans?
So co-signing a loan can be a wonderful favor to do for someone, but in some ways it can be riskier than just giving them money. If the other person can't repay the loan, you could be on the hook.
And it could also take a hit on your credit score.
That's exactly right, Sue. Now, if you're worried about your credit, but you still want to help someone, a direct loan might end up being the way to go.
All right, we've covered when making loans to friends and family makes sense, but what about whether to give the loan?
So this is where things get tricky. Investopedia reminds us to make loans to people we trust. The example they give is to be more cautious about giving money to a distant cousin than you might be about lending to a parent, sibling, or child.
Well, what if you don't trust your parent, sibling, or child?
See, now that is a great point, Sue, because just because someone is a close relative to you doesn't mean that you can necessarily trust them to pay you back.
Yeah, and this is a decision that you have to make with your gut, and it's not always easy to do that. So what are some obvious reasons not to lend money?
So the obvious one is if someone has a substance abuse problem, that right there is a good reason not to necessarily play Rockefeller.
Right, and that's a great example. I'm sure there are other serious issues that could give potential lenders pause too. But for instance, if someone is irresponsible with money or irresponsible in other ways, you may need to proceed with extreme caution, right?
Exactly. Or simply adopt the perspective that the money you're handing them is more like a gift and you don't necessarily expect them to pay you back.
Well, and that makes sense, Ryan. So what else do you need to consider before offering someone a loan?
So first, you need to look at your own financial situation. Can you actually afford to lend someone money?
Well, and that's a great point. I mean, do you actually have cash available, and how much will it hurt you if you don't get that money back? And if you can't afford to lend someone money, please don't. It's that simple. Depleting your hard-earned emergency fund to help someone else out is not a great idea. But what if you decide you can afford it and you will lend the money? What's next?
So this touches on something we discussed earlier, which is that you should treat it the same way as you would a bank loan, which is to say, get things in writing.
Well, what if I don't know what a loan agreement should say?
So the nice part about this is there are a lot of templates online that you can use.
That sounds really good, but what are the basic things a loan agreement should include?
So you're going to want to write down how much you're lending and when you expect them to pay it back. You want to be specific. If you want them to pay it back in a lump sum, specify that. If you're okay with them paying it back in installments, include that. Also, if you plan to charge the borrower interest, make sure you put that in the agreement itself.
Well, basically, it should include everything that you expect of the borrower.
Exactly. If you're expecting to be paid back in a lump sum while they are expecting to make installment payments, you're going to have conflict right there.
Well, it sounds like we've covered all the do's of lending to friends and family. What are the don'ts?
Well, we've already covered this one, but I think it's worth repeating. Don't lend more than you can afford.
Well, that is worth repeating, actually.
The next one is to avoid letting guilt drive your decision.
Oh, that's a good one, too. I mean, I can imagine some people guilt-tripping friends and family in order to get a loan.
And even if someone isn't trying to guilt you and that feeling is just coming from within, it should not drive your decision. You need to think like a bank. Assess the cold, hard facts.
Well, what about co-signing? We talked about that a bit earlier, but let's dig a little bit deeper into that.
That's right. And we've already talked about how co-signing can potentially harm your credit. What that means is that by co-signing a loan for someone else, you could be harming your ability to take out loans when you need them. So don't co-sign a loan for someone if it means that you might not be able to get a mortgage, a car loan, or some other personal loan in the future.
And it could be awkward to tell someone you're not lending them any money.
I'd say that an awkward conversation is much better than a tanked credit score.
Yeah, that's a very good point, Ryan. What are some other things that could tank your credit score?
So predatory loans can really hurt your credit. NerdWallet's article titled "What is Predatory Lending?" explains this.
Okay, so do they mean payday lenders? I mean, don't they usually target people with bad credit?
They do, but as the article points out, anyone can fall prey to a predatory lender. With a payday loan, you can't build your credit. They don't report to credit bureaus when you pay on time, but they sure will send a collections agency after you if you default.
So these loans will do nothing to improve your credit, but they can really hurt you.
Exactly.
All right, so what are the signs of a predatory lender?
So the first thing is, does the loan seem too good to be true? If so, it probably is. If they're promising things like fixing your credit, guaranteeing approval without checking your credit at all, or helping you settle your debts for far less than you owe, be wary.
Now, isn't it possible to settle debts for less than what you owe?
Sure, but you're probably going to need a lawyer and you have to pay a fair amount up front. Anyone promising to do the work for nothing is likely overpromising.
I got it. So what else?
So if they won't tell you what the annual percentage rate or interest rate is, consider that a red flag as well.
Well, that's a good one. Lenders should be transparent about that. Don't state laws require lenders to disclose that?
They do, but some lenders will hide it in the fine print or refuse to answer questions directly about it. These are going to be the ones to avoid.
I think we have time for just one more.
Well, if getting approved for a loan is surprisingly easy, if it's much easier than getting approved at a regular bank, there's probably a reason for that. If they don't do a credit check, it's because they're going to make up the risk they're taking by charging insane interest rates.
In other words, they take advantage of people with bad credit.
Exactly. That's why they are considered predatory.
Wow, that segment really flew by. Viewers, if you have any questions about loans of any kind or your overall financial strategy, contact us at retirewithbuska.com or call 715-355-4445. We'll be right back with more of Financially Speaking after this.
Do you have a plan for how your assets will be handled after you're gone? Without one, the state could end up making life's most important decisions for your family. Through our partnership with Estate Guru, we make estate planning process simple and affordable, offering wills, powers of attorney, and revocable trusts. On average, our service costs 70% less than the traditional estate attorney fees, and you may even qualify for free financial and healthcare power of attorneys. Call our office today to get started.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way that we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now might be a great time to get a second opinion on your retirement plan. Call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your complimentary, no-obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.